So I hope you're sitting in, 2-hour chairs for a 90-minute rather than a 1-hour chair. This is going to be long. And this is also going to be like an MBA in 1 hour and in 30 minutes. So you'll see what I mean by that. We're going to cover everything that's in a curriculum of any of the MBA programs. So who will benefit from this presentation? Managers who have previously struggled at promoting financial planning and analysis, enterprise performance management, and integrating business analytics into their decision support systems. Managers who intend to champion any or all enterprise performance management and business analytics improvement techniques and need a compelling call to action. And the reason I have champion in quotation marks is because it's been my observation that although it's nice if the senior executives sponsor new initiatives or progressive methods or innovation, often they are preoccupied with firefighting and short-term priorities. It's typically managers 1, 2, 3 levels down in the organization chart who kind of have passion or fire in the belly and ask themselves, how long do I want my organization to continue to perpetuate using stale and arcane methods? And they're the ones that'll do a proof of concept or a pilot project and demonstrate to their coworkers, line managers, colleagues, executives above them that this is the way to go. So if you're 2, 3 levels down in the org chart, that's fine. I like presenting to you. I do like to start with these 3 questions. What, so what, then what? So imagine your organization implements one of the many methods. I'm going to be talking about 5 or 6 methods during this webinar in your organization. I say celebrate for 1 day. You are not done. You and your colleagues will see much more information about themselves that they've ever seen before, and some will be actually contrary to their belief system. So that begs the question, what's relevant? So what? But arguably the more important question is the third question, then what? Because all decisions only impact the future. And we will talk about the predictive view, forecasting, driver-based budgeting, rolling financial forecast, what-if scenarios. That's the important question. So my agenda is I'm first going to clarify the confusion and lack of consensus. What is this enterprise performance management? I'm going to briefly talk about business analytics, data science stuff. Then I'm going to talk about 8 pressures that have caused interest in EPM. That's going to take me 3 or 4 minutes. At the very end, I'll talk about sports. But the majority of the presentation will be diving into, I think, 4 of the 8 pressures, and then I'll bring it all together at the end. I like starting with this cartoon. Drowning in data, but starving for information. You have this poor beleaguered clerk, sad, shoulders hunched, paper all around him, and the supervisor in the doorway to the left is asking him, looks like you've got all the data. What is the holdup? I gave you the request this morning. How come you don't have the answer this afternoon? And the message here is there's a difference between data and information. You convert data, typically it's transactional from, procurement systems, invoicing systems, payables, payroll, and the like, into information. So I said there is confusion and lack of consensus about enterprise performance management. Is it human resources performance management? If you do a search like in Google just on the 2 words performance management, the majority of the hits will be the HR or personnel function, like employee appraisals. The problem there is the few authors like me that have written books on this, we forgot to put the E, the enterprise or the corporate, CPM, EPM, they're synonymous in front. Is it scorecards, dashboards, KPIs and measures, the alignment of the employees with the strategy of the executives? Yes, but that's a subset. Is it about process, productivity, and quality improvement? Yes, but that's also a subset. Those 3 are typically referred to as business process management. That's the world of lean management, Six Sigma. Or is it all the above and even more? And it is. And the good news is this. Enterprise performance management methods, are not really new things that managers have to learn about, but they are things that have already been written about and they may be familiar with. They may not have implemented them in an organization, but they're aware of them. The problem is for organization staff implemented them, they do it in isolation of each other. So you got profitability analysis reporting in one part of the building, pricing in another part of the building, enterprise risk management, other part of the building, process improvement, other part of the building, and so on and so on. You get the idea. You get a lot more power and synergy when you seamlessly integrate all of these various EPM methods like gears in a machine and even more power when you embed into them analytics of all flavors, regression, correlation, and we'll talk about that. So since you can download these slides, there is the definition I just provided you. It's the integration of multiple methods with each embedded with business analytics, such as segmentation, but especially predictive analytics, that future view, which we'll talk about. And the primary purpose of them all is to achieve the strategy of the executives and make better decisions. So let's briefly talk about analytics. I could give you a definition from Wikipedia, but rather than give you a definition, let's just work backwards with the end in mind. Regardless how it should be defined, there should be no argument as to the purpose of analytics: better decisions, better actions. Analytics goals should be to gain insights and foresight, solve problems to make better and quicker decisions with more accurate and fact-based data, and to take actions. So I sort of lied to you. I wouldn't give you a definition. That paragraph at the bottom, that's not a bad definition. Here's the sort of the continuum spectrum of analytics. We start looking backwards: descriptive, pie charts, histograms. Then the next stage up is diagnostic. You can see that black dot kind of on the exponential curve, gets kind of an outlier. Then we go to the predictive view, predictive analytics. And then ultimately, I call it Mount Everest prescriptive. And some of you may have noticed one of my books was Predictive Analytics. I wrote it, co-authored it 10 years ago. When I wrote that, I thought, oh, that's really as far as you can go. And then the operations research community said, no, there's prescriptive. Of all the choices you can make, what's the best choice? You may get a kick out of this. I read an article a couple of years ago that described the relationship between how much money parents spend on their children's wedding and how quickly the kids may get divorced. And it was basically, a linear regression line. So you can see as we move from left to right, the more money they spent, the vertical axis is, the quicker the divorce. So what can you conclude? Well, typically when I'm in a seminar hall with people, they'll raise their hand. Some people will say, well, elope, don't spend any money. Others have an interesting hypothesis that if the parents are very wealthy, that could actually create tension and conflict among the couple and create the divorce. But there's another message here. Just because that line looks like it's a relationship, correlation is not necessarily causation. So you need to be careful. Just because you may have a line that looks like it's correlation, it may actually be the root cause. So unifying performance management with business analytics. Business analytics reporting consumes stored information. But what business analytics does is it produces new information from the stored information. And then what the enterprise performance management methods do is they will deploy analytics in the context of the various methods. I won't have time to give too many examples, but we'll get to that later. So insights and actions. Queries simply answer questions. What business analytics does is it creates questions. Further, business analytics then stimulate more questions, more complex questions, and more interesting questions. And most importantly, business analytics also has the power to answer the questions. And I'm going to get a little serious here, although some of you may be saying, Gary, you sound like you are serious. No, I'm a pretty funny guy, but I'm going to be serious just for a minute. I think in the past, the best leaders and the best executives had the best answers. Today, I don't think that's the case. Today, I think the best leaders and best executives have the best questions. There's too much volatility. There's too much uncertainty. There's too much, if you will, it's just too much going on for them to rely on their gut feel or so-called sixth sense or the types of answers they had earlier in their career that got them promoted to the top. They need to create a culture of investigation and discovery and tolerance for making mistakes, as long as you learn from the mistakes. So I want to contrast business intelligence with business analytics, because business analytics is actually a stage above BI. BI has actually been around for over a decade. It's really more descriptive. It's really about reporting, kind of using a Darwinian approach. We start with standard reports, ad hoc reports, query, drill down, OLAP. Many of you know OLAP, I mean the acronym, Online Analytical Processing, alerts. But what business intelligence does is it takes it to a higher level. We start with statistical analysis, regression, correlation, clustering, association. I know some of you took those courses in college and you just wanted a passing grade and get the heck out of there. Well, sorry, It's here, data science. But the good news is you don't need to go to your attic or basement and, grab out your college textbook, but you do need skill sets in your organization that have these capabilities. And then we move up to forecasting, predictive modeling, and then, I always refer to Mount Everest optimization, what's at the top. Now, you may find this interesting. There was a celebrity over 10 years ago. You'll know his name his or her name when I give it. That at the beginning of their career with their publicity agent, they looked at the top 10 grossing revenue films in history, and all top 10 films had special effects. And all top 10 gross revenue films had special effects and an alien. And all top 10 gross revenue films had special effects, an alien, and a romance line. Who is the celebrity? Will Smith, Independence Day, Men in Black, I, Robot, I Am Legend, Hancock. Hancock, which was criticized by the movie critics, but successful at the box office. But analytics is in so many other places, sports teams. Incidentally, I'm very involved with the Professional Society of Operations Research Community. It's called Informs. If you want to go to their website, informs.org, was the merger of the Institute of Management Science Operations Research. I'm on their sports analytics team. Search on my name there and you'll see some really good articles about sports analytics, crime prevention, music score. But what about business analytics in mainstream businesses and in government? Well, here's a laundry list, and I'm not going to go through all of them, maybe just two or three. We'll start with retail sales and merchandising. For slow moving items, you move them down into the basement. You want to mark down the price so you can sell them and not have to take them to the landfill. Financial services, risk and loan credit scoring, pharmaceutical analytics, drug development, clinical trials. My daughter is a clinical trial manager here in the Raleigh, RTP, Raleigh, Durham, Chapel Hill area. Let's scroll down to supply chain and transportation analytics, route optimization, hospital analytics, patient scheduling. You get the idea. It's pervasive. It's everywhere. So let's talk about enterprise performance management. Why is there interest? And I'm going to take maybe 3 minutes to go through these 8 reasons. And then the rest of the presentation, I'm going to drill down and I think about 4 of them. We'll start with the first one, executive frustrations with strategy failure. Executives are pretty good at formulating strategy. Their big frustration is failure to successfully implement and execute the strategy. And there's a fair amount of empirical evidence on this. There's a executive recruiting firm in Chicago, Challenger, Gray, and Christmas. They monitor the involuntary turnover of CEOs, the firing of CEOs. It's increasing every year. And I think it's because post-Enron board of directors take their governance job far more seriously. And a good example would be Carly Fiorina at Hewlett-Packard. The board of directors gave her a few years to implement the strategy. She didn't. They terminated her. Number 2, increased accountability. Today, there is no place to hide. Managers will be monitored. They will be measured. It doesn't necessarily mean their jobs are at risk, but it could adversely impact their salary increases or job promotions. Number 3, more rapid decision making. Unlike a few years ago when you could test and learn and have meetings in conference rooms, today employees will be on the phone with a client or customer, go or no go, yes or no. They need to make that decision in real time. They almost wish an executive was sitting next to them saying, what decision should I make that complies, aligns with your strategy? 4, mistrust of the managerial accounting system for transparency and accuracy. The reality is most managers do not trust the management accounting system data. Why? Because of overhead allocations. We'll talk about that. They know they're flawed and misleading. 5, poor customer value management. The reality is customers are the source of value creation for shareholders and owners. So we need to really connect customer information to shareholder information. The problem is the CFOs are not reporting this information. They're stopping halfway, this product gross profit margin reporting. We'll talk about number 4, number 5 in a few minutes. 6, contentious budgeting, poor resource capacity planning. This may surprise you. I think the annual budget process is so broken. in such a disaster, my advice is stop budgeting. Well, did I catch your attention? But that begs the question, what was the purpose of a budget in the first place, and how might we replace it with some of the EPM tools and methods? 7, dysfunctional supply chain management. This may not apply to all of you, those of you who may be in the retail space, we call it business to consumer, business to customer, B2C. But those of you that are in the business to business, B2B, the issue here is most customers treat the suppliers as the enemy. It's an adversarial relationship. Yeah, let's negotiate prices down on our supplier. If we put them out of business, so what? We could always get another supplier. That's got to stop. It needs to be a marriage. Supply chains are competing against other supply chains for share of wallet or purse. So they need to work together to identify mutually beneficial projects or initiatives to reduce cost for each side. And finally, number 8, unfulfilled return on investment promises from large IT systems such as enterprise resource planning systems, ERP, or customer relationship management systems. And the message here is, if you ask an IT director 3 years after they've gone through the long journey of implementing that ERP system, you ask them, how well do you believe that the return on investment is meeting or exceeding what the ROI that the software salesman sold you on 3 years ago? Many of them will be hard pressed to say yes. We put in a lot of effort. I'm not sure we've got the payback. That does not mean you shouldn't implement the ERP system. You have to remain competitive. But they produce a lot of data, not necessarily the information I mentioned in the cartoon. And so what these EPM methods do is they release the ROI like seeds from the ground and create the ROI. So I'm now going to drill down into these 4 of those 8. And a lot of this comes from a part-time role I had when I retired from SAS. I had a part-time role with the Institute of Management Accountants. There are actually 140,000 members in I think 130 countries. It was called the Executive Resident, voluntary, unpaid. And if you go to those 2 links, it's a pretty good article that'll cover much of what I'm talking about here. It's a 2-part series, Trends in Management Accounting. So let's start with the first of the 8 causes, failure by executives to execute their well-formulated strategy. And here's where we're going to need to talk about the balanced scorecard, which you may have heard of, and something called the strategy map. You'll notice at the ellipse in the oval, the strategy map is going into the balanced scorecard. I'll talk about that in a second. But above both of them is something perhaps more important. It's the vision and mission statement. That must come from the executives. That's their job. Their job is to set direction. Their job is to answer the question with the vision statement, where do we want to go? But with the strategy map and balanced scorecard answer is a different question. How will we get there? What are the projects? What are the initiatives? Now, many organizations allegedly claim they have a balanced scorecard. When I've asked them, do you have a strategy map? They say, what's that? This may surprise you. I think the strategy map is 10 times more important than the balanced scorecard. The balanced scorecard is just a feedback mechanism. The strategy map, which I'll show you in the next few slides, is more critical. The strategy map and the balanced scorecard, they're mechanical. They help realize the vision and mission. They're like one of these many gears, my analogy or metaphor of the EPM methods. Now, real quickly, here's a generic description of a strategy map. It was created by Professor Robert S. Kaplan and Dr. David Norton. What Kaplan and Norton recognized was a couple of things. One, the executives were overreacting to financial results reported at the end of the period. He said, you need to shift your attention to non-financial measures reported during the period so you can react to them. And they created these 4 perspectives that have cause and effect relationships from bottom to top. Each of those rectangles is a strategic objective. I'm going to actually show you an example on the next slide. So if the managers are accomplishing the strategic objectives and the learning and growth, and they will contribute to the internal process improvement objectives. If they're accomplishing those, they'll contribute to the customer retention loyalty objectives. And they're accomplishing them, they'll contribute all the way up to the top to the financial objectives. So those arrows, those are measures. We call them key performance indicators. You get what you measure. If you can't measure it, you can't manage it. If you can't manage it, you can't improve it. The other reason Kaplan and Norton created this is most employees and managers don't understand the executive team strategy. I mean, for example, if I went into your organization, and if you're from a consulting firm, be thinking about some of your clients. And if you are from a consulting firm or a CPA firm, please contact me, because what I'm doing now, I mean, I'm partly retired at 72. I like training. I call it knowledge transfer, how you can help implement these methods for your clients. But back to the issue of managers not understanding the strategy. Imagine I went into your building and randomly interviewed 15 employees in the hallway and said, quick, 30 seconds, can you articulate your senior executive strategy to me? How many of them could do it or do it well? Probably none. Well, if managers and employees don't understand the executive team strategy, how do we expect them to understand what they do each day, each week contributes to the strategy? So part of what the strategy map is about is communicating strategy of the executive team to the employees in the way they can understand it. Now, here's a fictitious strategy map, typically 2, 3, or 4 strategic objectives in each of the 4 perspectives. But to sort of summarize, we start at the bottom. A learning environment will stimulate process excellence, the land of process improvement, lean management, Six Sigma. That'll lead to customer intimacy, retention, loyalty, and that'll create the financial value. Now, there is an issue. I mean, I've been around a long time and being with software vendors that actually had these tools. I asked some of our customers, hey, you've got the strategy map in. How many KPIs do you have? And they'd say, oh, we have 300 KPIs. Oh, that's wonderful. How can they all be a K? They can't all be a key. So I'm going to show you in the next slide the difference between what I call key performance indicators that are strategic and operating performance indicators that are more operational. I'm going to go through it fast. If you want to read the article, it's about 11 pages. This next slide it's in that link, is Exhibit 3 on page 7 of 10. So how does the slide work? Let's start at the top. We see KPIs, and then further bottom right, OPIs. They're all measures. They're all important. They just serve different purposes. KPIs are strategic, okay? And one of the points to them is they must have targets. Without targets, basically, it's like the carrot for the mule or the donkey. You're not going to get there. Look to the far right, frequency of reporting, quarterly, monthly. Once we start getting weekly, daily, we're no longer in the land of strategic KPIs. We're in the land of operational PIs. Another difference, strategy map must be derived from the strategy diagram. Notice I replaced strategy map with strategy diagram, because some organizations, like in chemicals, will have a 5th perspective, safety and health, as an example. But you want to tailor those KPIs like a men's or woman's suit of clothes. Another differentiator, you need to have 2 types of KPIs, process-based and project-based. But when people hear project-based, they say, what's that all about? Well, strategy is all about change. It's not about doing the same things over and over again a little bit better. So an example of a project-based KPI would be percentage of completion or milestones. And at the bottom, the budget is typically disconnected from the strategy. I'm going to talk about that later. So sort of summarize, the definition of a KPI, which they should be displayed in a balanced scorecard, because we have interdependencies. The definition of a KPI is monitoring the progress towards accomplishing the strategic objectives. It's for strategic management. The definition of an OPI is really more like measuring a process, cycle time reduction, quality improvement, and the like. Incidentally, if you're interested in how to quickly implement a strategy map and balance scorecard, this is one of the things I kind of do, being partly retired. I do a 1-day workshop. And the way it works is it's based on the premise that managers learn by doing. And a fast way is this 1-day workshop, and it's predicated on strength, weaknesses, opportunities, and threats. You've probably heard the acronym SWOT analysis. And you notice the photograph at the bottom left. What I do is the night before, I ask the 5 or 6 executives that'll be coming to the workshop, create 20 yellow Post-its with the strength, weaknesses, opportunities, and threat. And at then 8:30 in the morning, notice the picture to the left. I say, go to the wall. And now I've got the perspectives horizontally, learning and growth to process to customer to financial. I said, put your yellow Post-it in one of those 4 categories. Now look at the middle photograph. I then tell them for the next 30 or 45 minutes, go to the wall and look at what were yellow Post-its that seem to be similar. And since they're stickies, move them in alignment with other ones that are similar. And 45 minutes later, look at the result in the middle photograph. There's 2 to 3 clusters in each of the perspectives. And then the white sheets, those are 8.5 by 11. We then take some time and say, what are these as strategic objectives? Now look at the third photograph to the right. We're 10:30 in the morning. Now for the rest of the day, it's an exercise. We go to each of those strategic objectives and ask, what would be 1 or 2 projects that would accomplish the strategic objective? And then what's an example of 1 or 2 key performance indicators that we could monitor by putting targets on them? So by 3 o'clock in the afternoon, they've already constructed strategy map, with the KPIs. Now I give them really 2 paths they can go. Now, one path would be, hey, you come back tomorrow and do this a little more slowly. I did this real quick because I'm getting on a plane and flying home, Or the other path you should go, which I suggest, is delegate those strategic objectives, the white sheets of paper, to your first and second line managers. Give them 1 week for them to identify the projects and initiatives and for them to identify the key performance indicators. What's the value of that? Quite a few things. One, for them to do it, they're going to understand the strategy. So that solves that problem of 15 employees in the hallway that don't understand it. But the other thing is they're going to have ownership of those KPIs because they're ultimately going to be held accountable. And they got to have buy-in. If the executives create the KPIs and kind of like mandate them, shove them down the throat of the managers, they're not going to have the buy-in. So they're going to basically believe more in those KPIs. So a way to sort of summarize this is imagine if every employee every day in your organization could answer this single question: how am I doing on what is important? How am I doing on what is important? Well, the first half of the question's easily answered. They come in the morning, they turn on their computer screen, they may have 3 or 4 dials for their KPIs. They can say, is the dial favorable or unfavorable to the target set by the executives? It's the second half of the question is the challenge. What is important? What should be these KPIs that we should measure? The strategy map and balanced scorecard provide this answer. The overriding purpose of a strategy map and its balanced scorecard system is to make mission and strategy everyone's job. It's like almost making owners out of the employees. So let's move on to the fourth of the 8 forces that have caused interest in EPM. Mistrust of the managerial accounting system and its flawed cost allocations and misleading cost reporting of outputs, products, standard service lines, channels, customers, and outcomes. And the key word there was cost allocations. And this is where the methodology of activity-based costing comes into play. And so let me give you a quick definition because it resolves this peanut butter spreading, I'll get to that in a second, of overhead. Imagine you go to a restaurant with 3 other friends. You order a little salad and the other 3 order the most expensive item on the menu. And at the end of the meal, when the waiter or waitress brings the bill, the other 3 say, hey, let's split this check evenly. How do you feel? Not fair, not equitable. Well, that's how products and standard service lines, incidentally, notice I use the word standard service lines because this is not about manufacturing. In fact, I just learned recently that in the United States, only 8 out of every 100 jobs make products. The other 92 basically delivers services. And incidentally, one other thing, if any of you listening are from a government agency, and I don't have it in slides in this presentation, feel free to communicate with me. I recently authored a book, Value-Based Management in Government. My co-author was the CFO of the Department of Labor and the Department of Education, or basically just look it up in Wiley. It's a lot of the same methods that are used here can be used in public sector government. So let's go back to this example of it's unfair. The products and services also feel unfair, just like you would in the restaurant. And the problem there is the accountants, they tend to be, I think, it's a little too convenient. They allocate overhead to products or service lines using these simplistic factors like number of labor hours in manufacturing, or number of units produced, or sales dollar amount, or the number of employees, or full-time equivalents, or square feet, or square meters. None of those cost allocation factors reflect the unique consumption that the diverse products and services consume of the end-to-end business processes and the work activities that belong to them. So if you were, I'm going to talk accounting speak here, if you will decompose that big fat overhead cost pool into multiple pools and trace and assign them with a cause and effect relationship, we call it an activity driver, you will discover that compared to that butter spreading, some of the products and service lines were overcosted and the others must be undercosted because it's a zero-sum error game. And yes, their convenient way will satisfy the external audit with the auditors, EY, KPMG, Deloitte, but it's wrong in the parts. So the simple definition of activity-based costing is as if the waiter or waitress brings 4 individual checks. You only pay for what you consume. Now, the reason there's been interest in ABC in the last, let's say, 50, 60, 70 years has to do with this diagram. It has the 3 universal components of any organization's expense and cost structure. You've got the direct recurring labor at the bottom, and I use the word recurring again because service organizations, banks, insurance companies, they don't like that term direct. They think, it's for manufacturing. Material in the middle and the overhead at the top. Notice what's happening. As the years go by, the indirect expense is displacing the direct. And when you ask people why, they'll say, well, automation, computers, robotics, we're displacing the frontline workers. That is secondary. The main explanation for this displacement is over time, all organizations have had an increased proliferation of different types of products. Manufacturers, more colors, more sizes, more ranges, banks, more types of depository accounts, insurance companies, more types of policies. The point is this: whenever you increase the diversity and variation of the outputs, it just creates complexity. And the complexity causes the need for more and more indirect expense to manage it. So 70 years ago, when it was homogeneous products and services, few and narrow, the indirect was a thin veneer. All right, you could peanut butter spread it because the majority of the expenses were accurate from being direct. But look at the right. That's not the case today. The indirect is much more substantial. Now, the problem actually begins with his traditional monthly responsibility center cost statement. Every manager on the planet Earth recognizes this statement. I'm presuming all of you listening to me. Salary, equipment, travel. But the problem is when managers get this report, they ask themselves, how much insight and understanding do I get about the cost that I can influence and control and where it goes? And the answer is not much. Notice at the bottom, I say when managers get this kind of report, they are either happy or sad, but they are rarely any smarter. And it's not that the report is a bad report, it's a good report. It's just that it's structurally deficient. That salary, equipment, those ledger expenses is not structured in a way that it can answer the question. So what activity-based costing does is it converts the same 914,500 that was in the cost center statement into the middle, into the language of work, key scan claims, analyze claims, and then it reassigns those into the right, into the product, service lines, and customers just like the waiter or waitress in the restaurant. Okay. And when organizations experience successfully implementing ABC, they have an aha moment, because before ABC, they think that all the expenses begin at the left side of this diagram. After ABC, they realize no, it's the opposite direction. The expenses start with the product, service lines, and customers, which place demands on the workload in the middle, and then the workload draws on the spending or the budget or the capacity, and then the costs measure the effect in the other direction. So I'll repeat that. The demands on work flow right to left, costs flow left to right. It's a principle. Rules are many, but principles are few. Principle like speed of light or gravity. You can't violate gravity, but the accountants will violate it when they do that butter spreading of the cost allocations. Now, I've rotated the previous diagram 90 degrees to the left. It's not as simple as, we just take the ledger expenses and then we put them into these activity cost pools and then we somehow trace them to outputs. The diagram to the right is more realistic, because you've got support departments that support other support departments that ultimately support the frontline departments that actually interact with customers or make products. So it must be a multi-stage cost assignment network. And I want to warn you, the next slide is going to look somewhat complex, and I'm going to go through it fast. But if you have the time, if you go to the Institute of Management Accountant website, imanet.org, search on my name, there'll be an article called A Statement of Management Accounting, Implementing Activity-Based Costing. It'll take you through it more slowly. So here it is. It's not as complicated as you may think. It's got the three universal components of any costing structure. You've got the resources at the top, that's those ledger expenses, the work activities in the middle, and then they eventually pile up at the bottom into the products, services, customers, and something we call business sustaining. Now, you need to adjust your thinking here. This is not a process flow chart with swim lanes left to right. It's a reassignment network. So if the organization spent, let's say, $2 million in January, it'll be the exact same $2 million of work activities, and they will eventually accumulate in the bottom two right boxes into the customers and business sustaining. The bottom box, the bottom rectangle, final cost objects, think of that like the predator food chain. Large mammals eat small mammals eat plants. The cost will accumulate into the customers, but also something called business sustaining, because there will be some expenses that have nothing to do with making products or interacting with customers, things like the legal department. So we create a cost object there like senior management. We don't want to basically allocate any of those expenses to the products or customers because there's no cause and effect relationship. It's typically 10 to 15% of an organization's expenses. All of those arrows, think of them as thin straws or wide pipes where the diameter reflects the amount of money flowing through. That's why it reconciles that $2 million at the top, reconciles exactly to the penny to the $2 million at the bottom. The real message here is costing is modeling. Costing is not T accounts and journal entries, which is what accountants do. And I know all of you listening to me are from the IT, and I'm an industrial engineer, but I was a controller at age 27, but I like to say I'm an engineer masquerading as an accountant. You got to think like an engineer to do all this stuff. Direct cost, not broken. You may have data integrity issues there, but that's a different problem. Also, you may notice in the middle rectangle, you've got people activities and equipment activities. Men and women run machines, machines make products. Men and women drive buses, buses deliver passengers. So assets also basically have activities. You'll also notice kind of to the right in the middle box, there's a couple of red boxes going directly to the customer, not to the products and services. In a few minutes, I'm going to talk about how that applies to measuring customer profitability. Now, the result when you do ABC can be really shocking. What this diagram is showing is the vertical axis is the percent error between traditional costing, which is the horizontal line, and then the squiggly line is the activity-based costing. And the result is, to the left, typically because of all that butter spreading, when you remove the butter spreading and apply ABC, the simple products and services, in reality, they've been overcosted. They're like you in the restaurant that would be subsidizing those other three who ordered the most expensive item on the menu. To the right are the complex products and services, and they're actually, if you will, accumulating much more of the indirect than over. They're like those three in the restaurant. And the magnitude of error is not like 5 or 10%. It can be 50 to 100%. And the consequences are significant. If we look at the left side for the simple products, the problem is because they are overcosted, your competitors may come in and price 5 or 10% below your price and steal some of your market share. But worse yet, on the right side, the sales force, which thinks the products are profitable, but in reality, they may be unprofitable. The more they sell, the more profit you lose. Here is a diagram, a real diagram of the result of activity-based costing that steps on the previous slide. The vertical axis is the net revenues minus the properly calculated and traced activity-based costs. The horizontal axis is the cumulative buildup of the cost, but it is rank ordered, starting with the most profitable product, the second most profitable product, and so forth. The very last data point to the right will always exactly reconcile with the profit and loss statement of the company. You're looking at real data here. So in this particular company, this was a folding chair company. This was actually one of my clients with KPMG. They had 30 million in sales, 28 million in expense to net out at 2. The last data point is 2. There's always organization shock when the management team sees this graph, because their belief system is that blue line at the bottom. So, oh yeah, we made money on almost everything and lost a little bit. But the reality is the top line, because all that butter spreading was crushing or suppressing, if you will, the diversity and variation. And so the ABC multi-stage cost assignment network, all of the activity drivers and what have you, are detecting it and creating the top line. So the top line graph is truth, the blue line is false. We call these humpback whale curves because they look like humpback whales and they appear in any organization that does ABC. Some of you may be asking, well, wow, that's a lot of unprofitable products to the right. What do we do about them? Do we drop or abandon them? No, that could be a mistake because some companies deliberately have what are called loss leaders. They price them a little bit below the true cost because they are associated with winners, things like blades and razors. You know, you sell the razor, maybe a little bit of a loss, but you make up the money by selling the blades. I love this cartoon. This is kind of a criticism of the accountants. The signboard says answers. To the left, simple but wrong. To the right, complex but right. Look how many of the CFOs and the accountants are taking the left path. You know, they're doing that simple, oh, let's just use labor hours or sales dollars. So simple, even though it's violating the causality principle. Very few are taking the right path. And look at that left path, they're falling off the cliff, going bankrupt. Maybe that explains why Toys R Us or Blockbuster went bankrupt. Maybe they had bad data. Let's move on to the fifth of the 8 forces, the shift from being product-centric to customer-centric. The value of a company is a function of the value from its customers. The only value a company will ever create is the value that comes from its customers, the current customers and the new customers acquired in the future. To remain competitive, one must determine how to keep customers longer, grow them into bigger customers, make them more profitable, serve them more efficiently, and acquire relatively more profitable customers like your existing profitable customers. But we've got a problem again with the CFOs. They're not measuring customer profitability. They're stopping halfway at just the product gross profit margin line. They've got to continue the journey all the way to the bottom. So I'm saying, what about all the below the line calculated costs? Products and standard service lines are not the only thing for which accountants should compute costs for. What about costs that have nothing to do with making products and delivering standard service lines? The problem with traditional accounting's product gross profit margin reporting is you don't see the bottom half of the picture. And in the bottom half are expenses like selling expenses, distribution expenses, marketing expenses. cost to serve. To put this into a picture, if the big rectangle you see to the right is all the spending, let's say for the month of January, the accountants are only calculating the shaded part. It'd be nice if they used activity-based costing for the indirect into the direct. But what happens when we expand to distribution, sales, marketing, and G&A? I'm making the case that that's more important than the bottom half. And why? Here's 4 reasons. Start with customer retention. It is relatively much more expensive to acquire a new customer than to retain an existing one. Well, that's kind of a no-brainer because the existing customers, you've already got them. So they're what we call a sunk cost. And if you understand decision theory, you do not include sunk or fixed costs into the future decisions. You use variable expenses. I'll talk about that a little bit later. Number 2, sources of competitive advantage. As products and standard service lines become commodity-like, then the shift is towards service differentiation. And that the point I should have made is that customers do view suppliers as commodities. They all sell the same kind of stuff, more same stuff. Banks have same type of depository accounts. Next, one-to-one marketing. Pepper and Rogers, these are 2 gurus in the marketing world. They have hailed technology as the enabler to identify customer segments and tailor marketing offers. So what they're saying is work backwards, knowing the unique preferences, traits, characteristics, desires, tastes of customers, and tailor the price discounts, offers, marketing deals, if you will, to them. And finally, number 4, the power shift. The internet is shifting power irreversibly from sellers to buyers. And I don't mean just like you and your household with your family buying things on the internet. Today, a purchasing agent at a company with a click of a mouse can see 10 suppliers and all of the information about them. And this is a one-time event happening in our lifetime. So if you understand these four of what I call the perfect storm, and there's probably 5, 6, or 7, we need to understand much more about the lower half of the P&L. Now we've got the other problem, angel customers and demon customers. Every company has high and low maintenance customers. That's what angel and demon customers are. Examples of a high maintenance customer: always changing delivery schedules, always demanding special, not standard product, always returning goods, always calling help desk. Low maintenance customers, the angels, you love them. Never only buy standard, never change schedule, never call help desk, never return goods. If those 2 types of customers at the extreme ends bought the same volume, same mix, same price, they are not equally profitable because the high maintenance ones are causing you a lot more expense, lowering your profit. What really caught my attention, though, of this book cover is the subtitle, Discover Which Type of Customer is Which, and Turbocharger Stock Price. And that's what I meant earlier by connecting customer value creation with shareholder and owner wealth creation. Incidentally, this book is written by marketing faculty at Columbia University. They don't talk anything about management accounting in there. So real quickly, this is a decomposition of the multi-stage cost assignment network. I'm not going to go through it. It is in that 30-page statement of management accounting you could download from the IMA. But what it's really showing is you go from left to right as you bring in all of the various drivers. The contribution margin is being eroded, and it allows you to create this, a profit and loss statement for each customer. And the profit margins are layered like an onion skin, layer by layer by layer. And in this fictitious example of customer 1270, you'll notice there was a 30% composite average gross profit margin. I say composite average because they may have bought 20 products above 30, 10 below, but the composite average is 30. But between the 30 and the 8, 22 more points of profit are eroded. Nothing to do with making product, delivering the service, all with distribution channel and marketing. So if you were to calculate this for each customer, you can put them into a grid that looks like this, where each circle is a customer. The vertical axis on the grid is the product mix gross profit margin. The horizontal axis is the cost to serve, those angel low maintenance customers on the left, the high maintenance devils on the right. And now things become obvious. The most unprofitable customers are in the lower right because they're difficult to serve and they're buying low margin profit mix from you. The most profitable customers are on the upper left because they're buying high margin mix from you and they're easy to serve. And now the actions to take is move the dots from the bottom right to the upper left. And that would be a different webinar by a marketing person for CAI, not me. But I tell you what, a marketing person would give one example: unbundling, fee-based. Just like the banks were doing with depository accounts, the airlines charge you for baggage, or if you want to move from a middle seat to an aisle or to an exit row. So charge those high maintenance customers when they cause you the extra work. What's really happening here is there needs to be a shift in the CFO's emphasis. The CFO must help sales and marketing to better target customers. The spending budget for sales and marketing is critical, but it should be treated as a preciously scarce resource to be aimed at generating the highest long-term profits for the owners and the shareholders. So this means answering questions like, which type of customer is attractive to newly acquire, to retain, to grow, or to win back, and which types of customers are not attractive to do those things. And once you know the attractive customers, now comes the second question: how much should we optimally spend attracting, retaining, growing, or recovering each customer segment? And why is it an optimization question? Well, remember, look at the subtitle of the book: Discover Which Type of Customers Which and Turbocharge Your Stock Price. One can destroy shareholder wealth creation in two ways. The first way is overspending unnecessarily on loyal customers for what is needed to retain them. The sales force may be wine and dine them, or I could exaggerate a little bit, but no matter how much you were treating them nicely, they were still going to pay the same volume and mix. But you can also destroy shareholder wealth by underspending on marginally loyal customers and risk their defection to a competitor. So the question is, what is the optimum spending level for differentiated services to different micro segments of customers? And I can tell you, the marketing world, they already do a lot of segmentation, and it isn't just a grid, old, male, female, old, young. They may have 20, 30 segments. Each one is an optimization problem. This is why the CFO and the accounting department needs to provide this information to marketing and sales so that they will then be incented to basically manage the profitability, increase customer profitability for shareholders. If some of you are in the supply chain area, very briefly, I recently co-authored a book with two faculty members at University of Texas, Supply Chain Costing and Performance Management. You're welcome to basically go examine it in Wiley. There's the link to it at the bottom. Now, some of you may be saying, golly, Gary's sort of convincing us that we probably should be doing this activity-based costing at our organization. And I tell you, I know that 90% of organizations that should be are not. But you're also thinking to yourself, wow, the accountants, what they're probably saying is, wow, there'd be a mudslide of data. There'd be 3,000 activities in that thing. And every one of them, we'd have to extract some sort of, transaction data from our ERP or our production system. Every employee would have to fill out a timesheet. Employees hate timesheets, and on and on. And those are all misconceptions. But the problem is that was what was happening in the 1970s and 80s. And a lot of activity-based costing systems were unsuccessfully implemented. Some of you older people may even remember that. You thought, oh, isn't ABC dead? No, ABC is just full absorption costing done correctly. But the problem is that the consultants either were going for way too many billable hours, so they wanted to take 6 months to a year to implement it, make a ton of money, or the models were way too large. I have a technique, and again, I can train. If you're a consultant or a CPA firm, contact me. I'll train you how to do what I'm about to describe, or I can come in if you're interested yourselves as a company. I call it rapid prototyping with iterative remodeling, similar to like those yellow Post-its for the strategy map. Model 0, one day, first day, bring in 5, 6 cross-functional people into a room, quickly build a high-level ABC model, not intended to produce any accurate results. Next day, bring in the line managers and the executives, maybe even board of directors. They see it in the debriefing. The light bulbs go on with everybody. It's engaging. It's their own company. Oh, that's how we can get rid of that butter spreading and truly know our profit margins. Oh, that's how we could really understand customer profitability. Oh, that's how we could do benchmarking with apples and apples, not apples to Oreos. Oh, it's accelerated learning. Then the next step is take a week, decompose the model a little deeper, maybe a second iteration in 3 to 4 weeks to the right, a permanent, repeatable, reliable production system. As I say at the bottom, make your mistakes early and often, not later when the system is too hard to change. And the reason that doing this works has to do with this graph, why this rapid prototyping technique works. The vertical axis is the accuracy of what you want to know, let's say a product cost or a service line cost. The horizontal axis is the level of administrative effort to collect the data, calculate the data, validate the data, report the data. Notice you will always get an asymptotic curve that goes up really quickly. The big black line to the left levels off to the right, and then you get diminishing returns on extra accuracy for the extra level of effort of work. So the message here is stop at the elbow. 95%, good enough, This is management accounting. This is not external financial reporting for statutory and compliance. If the CFOs get those numbers wrong, they go to jail. But if they get the management accounting numbers wrong, they don't go to jail. So, just get it directionally correct. And what's really counterintuitive is the primary determinant that creates that slope up to the right is the multi-stage cost assignment network. It's that piping diagram that I gave you or that I showed you earlier. At the bottom, I say, is the higher climb worth the better view? So benefits from rapid prototyping, accelerated learning, people get it. It solves that thorny leveling problem. Oh, how many activities are going to be? 3,000. By the second iteration, it has right-sized itself. Typically, they're about 50 to 70 activities. It prevents the over-engineering that gave ABC the bad reputation and black eye of the previous decades. Also, I didn't mention peer group predetermining uses. When I do that workshop, 3:00, second day, I go around the room, the people invited in, I said, when this system is in place 3 weeks from now, how will you use it? What decisions will you make? Next, what will you do? We're getting their buy-in. We don't want to have like the baseball movie, Field of Dreams, if we build it, then they'll come. All right, number 6 of the 8 forces, budgeting. The problem here is the budget is typically a fiscal exercise done by the accountants that has 2 problems. It's disconnected from the executive team strategy, and it's not based on future driver volumes. All right, this may be funny. How many of these apply to your organization? Our annual budgeting process exercise, invasive and time-consuming with few benefits. Takes 6 months from beginning to end before we publish it. Requires 2 or more executive tweaks at the end. After we publish it, give it to the executives. They don't like the numbers. They want more profit. Change some of the numbers. It's obsolete in a couple of months after we publish it anyway. Next, it starves the departments with truly valid needs. Maybe next fiscal year, there's going to be a lot more work in a department, but we didn't give them extra headcount. Next, caves into the loudest voice and political muscle. Look at me, gray hair. These are the older veteran sandbaggers. They're experts. They know how to pad that budget. Next, it incorporates last year's inefficiencies into this year's budgets. We have an inefficient process last year. We're replicating it this year. The last one at the bottom, and one that bothers me the most, because when a manager is on a glide path, let's say 4 or 5 months from the end of the fiscal year, it appears to them they're not going to spend all of the budget that was allotted to them for the year, what do they start doing? They start spending needlessly, foolishly. Why? Because they know that next year's budget's going to be pegged to a baseline of how much they spent this year, or kind of call it spreadsheet budgeting. Let me see what I'm going to describe may apply to where your organization, how it budgets. You give every manager, every cost center manager, a spreadsheet, January to December, with all of the line items of their expenses, including rubber bands and paper clips. They fill them out. You give them someone in the accounting department. They consolidate it, bring in the revenue forecast from sales, give it to the executives. They say, well, that's good, but not enough profit. Change some of the numbers. So you put all the spreadsheets back down. The The managers lower some of the numbers, back to the consolidation, back to the executives. That's a little bit better, but not good enough. Up, down, up, down, up, down, up, down. Come on. You almost want the executives to answer, what number did you want in the first place? Save us all this time with all the spreadsheets. But that would give us their aspiration, not what is reality. So I call that spreadsheeting the bad way. We project to the end of the year, column B, and then we give them a 5% increase for inflation, column B times 1.05, copy down. You should be laughing. So how can we improve this? Think about the amount of money being spent in the future as a result of two river streams. The upper river stream is the recurring, repeatable work. It's demand driven. The bottom river stream is non-recurring, non-repeatable work. It's project driven. I'm now going to decompose into each of them. For the upper river stream, for the activity-based costing, hopefully will have been done when it's done for profitability reporting. For the predictive view, we can calculate the model backwards. I'll give you an example in the next few slides. In other words, we basically forecast the volume and mix and all the activity drivers to solve for the level of capacity. So in other words, for the historical, we have resource expenses, process costs, and activities outcomes. But for the predictive view, notice start at the bottom, calculate backwards. I'm going to repeat this in a different way because here's how it works. For the historical view, the spending's known, we calculate the cost, but we pick up a bonus. We get the unit level cost consumption rates, cost per material move, cost per type of order, cost per this, cost per that. There's always going to be a unit level cost. For the predictive view, and now I'm going to put my industrial engineering hat on, I think it was second semester, freshman year at Cornell, 1967, demand, volume, and mix times unit level cost consumption rate equals the capacity required, meaning the number of type of employees with their salary and wage level, purchases with suppliers. For the demand, for the project driven, real briefly, the enterprise risk management community uses a diagram like this. Each of the circles is a potential risk event that may happen in the next fiscal year or beyond. The diameter reflects the amount of spending to mitigate the risk. The vertical axis is the severity if the risk was to occur. The horizontal axis is the probability the risk event will occur. So when you're the upper right, very painful, and it's highly probable, spend money on it. So revisiting river streams. For the upper river stream, do the backward calculation using consumption rates to solve for the level of capacity. For the bottom river stream, there's actually three types of, if you will, projects. There's strategic projects. Remember the strategy map and the balance scorecard? I didn't go into it, but you need to have strategic projects to implement strategy. I just showed you the risk mitigation. And third one, everybody's familiar with capital projects, for investments. Get ready. I'm going to decompose this diagram further down. And remember, you're going to be able to download, if you not have it already, these slides. The shaded boxes are the upper river stream, the non-shaded to the left or the lower river stream. Look at the derived budget and rolling financial forecast. The input from the top is the operational budget. From the left, we've got the three projects: capital budget, strategy budget, risk budget. Going back to the top, there's only one independent variable in this diagram. It's the forecast, because all of the other ones have been calibrated or they've been discretionary selected. So that bottom box, that derived budget, it's going to be a much better number than those cost center spreadsheets, up, down, up, down. Now, we will still have the same problem when we give the first cut to the executive team. It may not be acceptable. There may not be enough profit. Well, the temptation might be, why don't we postpone or eliminate the risk mitigation projects, or postpone or eliminate the strategy projects or capital projects? All bad. We need those to protect ourselves. The only lever here to basically lower that profit is driver consumption rates, productivity improvement, 2%, 4%, 6%. And that's where the lean management and the Six Sigma community comes into play. And incidentally, if we basically reforecast those forecast volumes, because look at what I'm showing you here. This is The vertical axis is the accuracy of a forecast. The squiggly line shows that that one day, 1 week, 1 month after a forecast becomes less accurate, reforecast, maybe quarterly. Put them back up. I wonder if I can go, yeah, put them back into this. And if you're using a financial planning and analysis software tool, they basically have the modeling capabilities. We recalculate, we get a P&L, not maybe just out to the end of the fiscal year, but maybe out 18 months, rolling financial forecast. And I'll tell you, board of directors are interested in this. Why? Because it gives you pro forma income statements and balance sheets. And the next step, net cash flow. And with the COVID pandemic, for their governance responsibility, they want to know net cash flow. Things do get tricky, though, when you do the predictive view, because if you look to the right, you have to classify the behavior of each resource as sunk, unused, or idle, fixed, step fixed, or variable. And the classification of each resource depends on the planning horizon. Because in the near term, you can't easily adjust capacity. You're not going to terminate employees on Tuesday because there's not enough orders in the house, but hire them back on Wednesday. You'll accept the day of idle capacity. But as you go out weeks, months, years, you may replace full-time employees with temporary contractors. You may lease assets that you normally would have bought and basically do on a time base. So it really becomes microeconomics. Again, this is why accountants need to think like engineers. I do want to put in something as I start basically concluding a little thing about myself in sports analytics. I mentioned earlier about Informs. I'm on this sports analytics section. Informs, again, is the premier professional society of operations operations research. If you're interested in reading either of the articles, there's the links to them, and you can read them there. But I want to talk about how analytics has been applied in baseball. Some of you may have seen the movie Moneyball or heard of the book. And for those of you who have not, or just to refresh your memory of some of you that have, Moneyball tells the story of how quantitative analysis can overcome perceptions of old school thinking. And it's based on the true experience of the Oakland A's and their general manager, Billy Beane, and it's played by Brad Pitt, if you may remember, as the actor. And the situation there is the owner of the Oakland A's isn't as wealthy as the big city owners who have been poaching, if you will, the high salary players like the New York Yankees as an example. But Brad Pitt playing Billy Beane early in the movie, he's at the Cleveland Indians office, kind of dealing and wheeling to get some players. And he sees that the owners keep looking at this young, if you will, almost like student, nodding his head, yes, no, And at the end of the meeting, he goes out into the office, into the cubicle where Jonah Hill is. And Jonah Hill is now playing this Yale University recent graduate, and he says, who are you? And they go out into the parking lot, and Jonah Hill, playing the Yale student, says, baseball thinking is medieval. They think winning games is basically getting high-paid players. It's about getting on base, and getting on base gets to, if you will, to runs. But you may remember halfway through the movie, what happens is it's called the streak. Now they use the analytics then to get low players that have kind of like low salary players, but they can kludge them together to being a winning team. And they do become a winning team. They get all the way, to the playoffs. But halfway through the movie, some of the coaches are sitting with some of the players like in the batting cage and said, in the strike zone, you hit the ball much better when it's the upper part of the strike zone, not the lower. They started using advanced deep analytics. And that's where the regression correlation, the use of advanced analytics comes into play. I do want to tell a personal story, though, about myself very briefly. I am in the Cooperstown, New York Baseball Hall of Fame for the oldest computer baseball game. It was a result of my converting my childhood dice baseball game into computer code for my 1970 junior year Cornell University Operations Research Game Theory course project. And just real briefly, a little more context. When I was 8 or 9, I played dice baseball. Two's a homer, three's a double. Junior year, I take the project, I replace the dice with a random number generator, basically big deck of cards. Some of you don't remember those still, a big IBM deck of cards. I got an A on the project. In 19, wait, when I was 27, what was 2000? Anyway, the annual conference of the Society of American Baseball Research, sabr.org. You can look it up. This is all the people who love baseball statistics, was in Milwaukee. And I went to it, I loved it, and I pay $100 a year to be a member. And every day you get a list serve, newsletter, people posting stuff like, oh, I looked at what left fielders hit home runs and away games, all these really conditional things. And so a couple of years ago, I read the listserv, and this guy says, I'm in the Baseball Hall of Fame for the oldest computer baseball game, 1972. And I said, well, my Cornell project was 2 years before that. So I call Cooperstown. I get the receptionist. She says, I'll connect you with James Gates, who's the curator and librarian of the Baseball Hall of Fame. He says, Gary, do you still have the program? I said, no, I don't have the deck of cards, but I'll mail you in the printout. I did. And 6 weeks later, I get a phone call from James. And he says, Gary, I have good news. You win. I'm in the Baseball Hall of Fame for the oldest computer baseball game. I tell my grandsons, it's not like, the Wright brothers or Lindbergh, but given the size of the computer game industry, pretty cool. That link at the bottom is a 20-minute interview about it. And there is actually the certificate. So let me start bringing it all together. What's really happening here is there is a shift in the return on investment from tangible assets to intangible assets, meaning the shift is from buying hardware or machines or trucks to an intangible asset like information. And in this diagram, you're seeing that the ROI from information increases left to right exponentially as you go from data to information to knowledge to insights to decisions. Unfortunately, many organizations are stuck in the first two red bubbles to the left. All they've got is raw data and standard reports. All they can answer is what happened. In some cases, in the third bubble, people like some of you listening to me may provide some of your managers, some drill down software. I'll give you examples: Click, Tableau, Microsoft Power BI, SAS, where I came from, so they can drill down to a line item of an invoice or a purchase order to see an anomaly, but they're still restricted to only answering what happened. Enterprise corporate performance management starts at the first blue bubble. All of these examples I gave you in the last hour and 15 minutes involve modeling. Costing is modeling. Strategy map is a model. So once you're there, not only can you answer what happened, you can answer why did it happen, because we're using causality principles when we do modeling. Then when we go to the next bubble, the predictive model, now we're looking through the windshield, not the rear view mirror. Now we can do what if scenario analysis, driver-based rolling financial forecast. At that point, we're not only able to answer what happened, why did it happen, what can happen, what are all the options and possibilities, true financial planning and analysis. And then when we get to the upper right box, prescriptive analytics, Mount Everest, of all the choices we could make, what is the best choice? And that could actually involve things like linear programming. So to sort of summarize, this is a picture of how it all fits together. Remember I mentioned we want to connect customers to shareholders. In this diagram, the big box is basically your organization, its assets and its people. I will walk you through how it fits in just a second. Where's management, accounting, and analytics in the diagram? Not there, because the output is the input to so many places. Okay, how does the diagram work? Start in the customer satisfaction box at the top. When we go to the left, the executives will formulate the strategy based on customer needs, typically. Go down, they will then communicate strategy to employees in the way they can understand it and assign KPIs. Now, back into the box, feedback. Remember, every day employees could basically look at their dials. Am I favorable or unfavorable? How am I doing on what's important? Collectively, when all employees can do that, it's how are we doing on what's important? So those three to the left, strategy management. Now, from the box up to customer, CRM, customer relationship management. That's that targeting. Remember customer profitability reporting. What types of customers are most attracted to retain, to grow, win back and acquire, which types are not, how much we spend. Now, for the counterclockwise circle, that's the process improvement stuff. Take the customer order, complete the order. End-to-end processes is very popular in the process world, and a most popular and sizable end-to-end process is order fulfillment. So if we're doing all of that, then we're going to connect the customers to the shareholders. Now, because I don't have animation with WebEx, usually with an animation, you can see little white bubbles. Imagine they're flowing through. This is like veins, in your body. Think of it like your heart system. Those veins are flowing. But to the degree that any of those veins might be constricted, I call it arteriosclerosis of the enterprise performance management. Notice that the money doesn't go all the way to the shareholders, owners. It leaks into the sewer. So to the degree we have, if you will, inefficient processes, poor targeting of customers. So I want you to think of this diagram as sort of like the vision of where you want to get to. And I wouldn't take 3 to 5 to 6 years to get the complete vision in. Try to do it in the next 6 to 12 months using rapid prototyping techniques. Let me conclude with my big frustration. Why is the adoption rate for analytics-based enterprise performance methods taking so slow? Well, one problem may involve you, IT, and the users on the other side. You both have common goals. You want to make better decisions. You want to optimize performance, manage risk. You want to achieve strategy. Now, I may basically bother some of you in the IT department, but I think there's an issue here. I think there's a wall between the users on the business side to the right and you on the left. What you are about, IT, is really, a set of technologies. You're the gatekeepers, daily operations keep, lights on, batch processing, data storage, data structures, your world. But on the right, the users want discovery, investigation, and analysis. The problem is each of you view the other side differently. On your side, you may view the business users as competitors. They went out and bought some software that was below the threshold of their manager, and they kind of screwed up, your portfolio. They may solve problems, but they don't operate IT the way you do. Also, they're risky. They may have low care about governance. 3 of them independently may have come into the customer master file, not knowing the other 2 were there, crashed the system, takes you a day to basically solve it. But on the business side, this is how sometimes they view you. You're obstructionist, you're controlling, you're uncooperative, you're bureaucrats. We want to change, and you say, fill out the form, we'll do it in 3 months. I'm exaggerating all of this. My whole point is this: the wall's got to come down. We need to have, if you will, interdependency, collaboration between the two. But the real barriers involve these 3 items. The first one, again, is IT related. Dirty data, low quality data, but you've got the capability using extraction, transform, and load, ETL, to fix that. And then you may have multiple hardware systems, Dell, IBM, Hewlett Packard. You guys can fix that, and women. Next is the perception. It's too complex. It's not affordable. I showed you that with rapid prototyping, you can implement these methods in 2 to 3 weeks. The real barriers got nothing to do with people, nothing to do with systems, nothing to do with technology, everything to do with people. It's behavioral issues. It involves resistance to change, culture, and leadership. Let's start with resistance to change. It's human nature. People like the status quo. Only babies like change, diapers. Other issues, fear of others knowing the truth. Oh, I don't want the others to know what things really cost. Fear of being measured, fear of being held accountable. Weak leadership. There, I said it. Not every executive team's got the highest IQ. So the point here is you really need to have some kind of organizational change management skills. And how many of you have degrees in sociology or psychology? Probably none. And in the interest of time, I've only got 4 minutes. I'll go through real quickly excuses. Why people won't go. We're profitable, so why does it matter? We'll purchase software that'll fix our problems. Well, a fool with a tool is still a fool. Software involves modeling. It's not transactional stuff. We already know our true costs. It's from our general ledger. It's in a system. No, you know your true expenses. You have to calculate your cost. We've done it this way forever. We don't do that here. We already know everything. It's in our heads. That's pretty arrogant. We're a small organization. We'll worry about better methods when we get larger. Well, you may be bankrupt before you get larger. All this hype is just made up stuff from highly paid consultants. Well, let me defend the consultants. You know, they can do something you can't do. They can focus, and you're going to be distracted. No one looks at the reports I create, so there's no point better generating better reports. That's sad. Go all the effort to make good reports, they throw it into the trash can. We cannot afford better software to fix our problems. Some of the EPM software is not that expensive. We're way too busy doing other things. The accountants are closing the books 3.5 weeks. They got to learn how to close the books quicker, so they've got the time to implement these things. We don't know where to start or how to get started. I already gave you examples with rapid prototyping. I love this cartoon. Another problem. The vertical axis is the math skill, the horizontal where you are in life. See, geometry, algebra. Boom, when we get into our job, back to spreadsheets. Complete vision, real quickly. To the left, cover of my book, greasy, grimy gears, teeth broken. They don't really work if you put them in your car, low fuel efficiency. Look to the right, titanium gears spinning faster revolutions per minute, digitized. Put that in your car. To the left, low fuel efficiency, right, high fuel efficiency. Now replace fuel efficiency with rate of shareholder wealth creation. We only have 2 minutes to go, and I know that Susan needs to do some conclusion. So this is just a bunch of links that of materials you could read based on what I wrote here. You get educated. You're doing that now. Rapid prototyping, start small, think big. And there's my email address, my website, across the tabs below them, free articles I've written, nothing to pay for. Oh, one last thing. Feel free to invite me in LinkedIn if you care to, but just put a message there. Okay, Susan.
Great. Well, thanks, Cary. Another great presentation. Awesome. Thank you.
My pleasure.